again, and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our Tuesday, October 10th edition of Market Insights and Observations. We're going to talk about three major topics, headlines that are around the world that are moving markets, so you should be paying attention to as we are. So thanks for watching, and let's get right to it. So, war in the Middle East. Israel is at war. Hamas is attacked. It's a travesty and a terrible event, and it impacts markets. And so let's get right to the first topic of the day, the last sort of 4 or 5 days that we saw play out this last weekend. Just a horrible attack. And ultimately, markets go through, digest sort of events that are tragic events that we've lived through in our past. World War II, 9/11, things of that nature. And we're going to talk about the market reactions and sort of how the market really reacts the first day, week, month, 6 months, 12 months, and sort of trading days of a historical performance report of how markets react or digest news such as what we just received. And also on Friday, we had a reversal. The equity markets turned up, the bond markets turned down. And why would that? Why, a lot of clients, investors have been asking. We just had a couple of reviews this morning with clients, and they were asking why are the markets up when we have geopolitical tensions and this war in the Middle East now breaking out, and it seems to it's going to get worse before hopefully resolution at some point in time. And the reality of where we are, and here's the explanation, is the Federal Reserve was intent on raising interest rates, right? And there was an 88% probability just 2 weeks ago that the end of the October 31st, November 1st, next Fed meeting, if you will, that they were going to raise interest rates another 25 to maybe even 50 basis points because of inflation, because of the job market, because the U.S. economy is so strong. And ultimately, what happened in the last 5 days is a reversal of all that because of the geopolitical uncertainty. And so what that did is that it was a signal to sort of the treasury markets that the Federal Reserve might be on pause for this next meeting, meaning citing all of the geopolitical tensions and the uncertainty that might give them the cover to say, hey, let's kind of take a time out, let's not raise interest rates. And so the market reaction just changed overnight. Now, why would the market go up as a result of that? Well, bond yields have come down, treasury yields have come down. That has put a bid under the market, meaning that the equilibrium, the equity market can actually now sort of see that there's a pause. And we don't know how long this pause is because we don't know how long the war or how major this will be. We also saw disruption in the oil markets, and the oil markets started spiking. That means that the disruption around the world, obviously, not only have Ukraine and Russia that hit the oil supplies, the U.S. coming offline in terms of being a net producer of oil, and then you add in, again, a disruption in the Middle East and Saudi Arabia, and all of this is going to point to higher oil prices, which ultimately translates into a deflationary event in the long term, which helps the Federal Reserve. Rob, how could higher energy prices, me paying more at the pump, be deflationary long term? Short term, yes, you and I are going to spend more money on filling our tanks. Long term, it's going to take the money out of our pocket today that we normally might have been spending or allocating in sort of a travel, leisure, or wherever. And that's sort of how the market sort of looks at this because, again, we don't know how long and how high oil prices will go. I mean, there's a talk of $100, there's a talk of $150 of, oil and Brent crude potentially spiking. But the internals underneath the S&P 500, this is an impressive reversal. This is a chart from Strategist again, shows how on Friday and Monday, ultimately we saw a range of just strong momentum. Now keep in mind, we still have a lot of things that could play out. The war could get even worse, which we anticipate, unfortunately, that could be the case. But we could also see the market sort of start surging, sort of a relief rally, because since the summer, the markets have been selling off and looking for clear direction. Now, if the markets do continue this rally, this relief rally, because interest rates might be sort of on a pause, look towards the 4,400 to 4,450 range on the S&P 500. What does that mean? That's just this line of a ceiling resistance right now. We could test it and stay underneath it. So that means that could lock the S&P 500 or the market in a range moving forward. Or we could test it, get, come back a little bit and then blow right through it and close above it. If we close above this range, this red line right here, that means that we have markets moving higher. But we got a lot of work to do between now and then. And then again, the S&P 500 has to show more momentum or volume for this sort of reversal in trend as of late for markets to continue to move forward. So this is a volume chart on the S&P 500. So we need this to continue to go higher for any further conviction. Now, there's support on yields, and that's roughly about the 4.5 on the 10-year, so 4.5 on the 10-year Treasury. So look, again, resistance line and support line. So in this case, this is a support line for the 10-year Treasury, and that's at the 450 mark. So obviously we saw yields spike up, and we could anticipate them hitting the 4.5 level. And then if it bounces off of the 4.5 level, that means that yields are going to go higher. The equity market could go lower. So that's why we're in a holding pattern right now. Again, we have cash ready to deploy. We also have treasuries coming and rolling due because seasonally, October has always been a sort of a volatile month, if you will. Now, this is a S&P 500 performance following significant historical events. And ultimately, this goes back to World War II, Pearl Harbor, JFK assassination, oil embargo in the 70s, the 87 stock market crash. It's got basically everything, the 9/11 terror attacks, Lehman Brothers, even Israel invasion that we're talking about today. And sort of the day of those events, yes, historically speaking, when those events break out, they're announced, it's disruption, markets trade lower. 20 days lower, or 20 days past those events, markets actually tend to do pretty well as they digest the news and they kind of see how everything shakes out. Now, this is not consistently the 20 days, 65, 125, and 250 days past, sort of those events, historically speaking, over time. And it's sort of a mixed bag, but it does show you that there's sort of more positive moving forward as markets digest this than negative. And then the further away we get from an event, the more market has the opportunity to adjust moving forward. Now, a couple of overweights that we've done earlier in the year. I've been in a lot of the news outlets, CNBC and Fox Business, if you will. And we talked about energy. So we've overweighted energy for clients. And energy now we could see catches a bid right now. Again, we could have never ultimately predicted what was going to happen here. But again, if you watched me on sort of those news programs, I constantly referred to a geopolitical hedge. That's why you want to have energy in your portfolio. So that thesis is playing out. Not that we want any of this geopolitical tension to ever help out, but there's are ways in the world that we live in today and invest in today to add common sense to your portfolio. And another way of doing that is aerospace and defense. Aerospace and defense, and we've added that as a long holding for our clients for a long time. We've had some aerospace and defense. And so we're seeing that catch a bid as of late, and we continue to see that trend, we believe, move forward in time. This last chart we're going to describe for you is it's basically the bond yield spread, okay? And the best way to describe it, I'm trying to sort of put it in terms that we can understand. Ultimately, it's the 2-10 spread, and it's the inverted yield curve. And we've had an inverted yield curve, and every time the inverted yield curve has been there, it's predicted a recession. And so going back to previous recessions, the red bands on this chart are recession. Okay, the most recent one is the COVID. And the inversion on the yield curve that we've seen some recessionary indicators. This is the zero line. I know you see some here, but they didn't pass the inversion line. We've been significantly inverted, and the question is, if and when we get a recession, is it 2024? Because everyone was predicting, everyone on Wall Street was 2023. We haven't seen that. We've seen strong earnings play out. We're going to go into the third quarter earnings reporting season right now. Next week, we have the banks to lead off the charge. And we're going to be listening to the earnings reports. And earnings move markets, and they keep markets where they are. They keep markets moving forward or higher, depending upon. So if corporate America starts reporting that there's some more trouble, I believe that they're going to cite geopolitical uncertainty. They're going to say cost of capital, and they potentially could point to more layoffs. Layoffs is actually good because it helps the Federal Reserve with a tight labor market and that sort of inflationary pressures built into the system that they're worried about for so long right now. And then the fourth quarter, S&P right now, all analysts are predicting a 12% rise in earnings, according to the S&P 500 sort of analyst reports right now. So we're going to see, do we end up with a positive year next year for 2024? Earnings are scheduled to come in by 8 to 12%, if you will, across the board. So there's, positive earnings means markets move up, traditionally speaking. So will we have a recession? Will it be a mild recession? Well, right now, this inversion reversal is indicating that the recession is now officially on the horizon, and ultimately we should be on recession watch. Because previously, if history repeats itself, it ultimately rhymes with history right now. But we're positioned for that, we're expecting that, and there's ways of making, sort of taking advantage of those opportunities. So that's what we're going to pay attention to, is the third quarter earnings season kicking off, and obviously suited the geopolitical tensions. But hopefully this sort of gives you a long-winded explanation as to why markets are moving up, even though we're seeing some, not so favorable headlines and geopolitical tensions around the world. So we'll stay on this for you. Thanks for watching. Again, like and subscribe, share with friends and family, and let us know if there's another topic you'd like us to cover. We're happy to do that for you. Take care and have a great day.